Only weeks are left. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, the unthinkable is about to happen, and I want you to see why this has dire consequences for the economy, because we're going to take a look at what's about to happen in the banking industry, something that very rarely happens and has absolutely serious consequences for the economy. And then when you pair this with what's going on in the consumer space, which is what we're doing at a truck stop today, because when you look at global trade and transportation, well, what's about to happen in the trucking industry, it's going to grind to a complete halt, and then you're going to see how this all feeds back to the consumer, to the banks, and why we're headed into a very serious crisis that's almost now weeks away from starting. Let's over to Zero Hedge, where we picked today's story up with a headline: U.S. bank deposits plunged last week as Fed rescue funding hits new record high. And this is a big issue because, a lot of Americans now have moved past the banking issue that happened back in March. They believe the regulators and the policymakers have stabilized it. They're starting to feel confident again. But when we examine the banking industry close up, we realize it's hemorrhaging. It's in serious trouble and it's not getting any better. In fact, I'm going to make the case it's about to get a whole lot worse in the next couple of weeks. Let's first take a look at what's going on in the deposit space here. And we have this chart, deposits at all commercial banks. And what you can see is on a year-over-year rate of change, they are negative. And this is something that doesn't happen very often. And we're looking at all of the data here that's available. We are back to the 1970s, and you don't see any sort of contraction except around, say, 1994 into 1995. And there was a mild, very soft recession, just a bit of a pullback there in the economy. But you'll notice deposit growth almost never contracts. And this is leading into something that many experts are worrying about, is a contraction in what's called the money supply. You'll hear it referred to as that, or what's called the M2. And you'll notice that they're almost the same thing. They're very close. So what we're seeing here inside the banking industry is deposits are going away. Now there's two factors there. People could be moving their deposits to somewhere else outside the commercial banking system, which would be fine. But the other factor is, in a debt-based economy, when people make a principal payment on a loan. Now, it could be a one-time principal payment, or it could be part of your regularly scheduled payment. When that principal payment hits, money is destroyed from the system. So what we're seeing here is a vacuum pulling money out of the system. And this is a huge problem, as we can see on the next chart, because what we need is our banks to be healthy here. And if not, what we're facing is at the next slowdown, which I'm making the case is coming very soon, the banks are going to be at the epicenter of the next financial crisis again, because they didn't heal. The regulators and policymakers didn't do anything but put a bandage on the situation, and it's not working. Here you can see that the Fed's usage of the bank's usage of the Fed's emergency funds rose yet again. Now only $144 million, but it's a matter of a new record high, and this isn't getting any better, because when you look at deposits, which is what banks need, this is really what keeps them solvent and in good shape, is a steady growth in deposits. They're losing them. They're going away. And you'll notice this correlation between, of course, the Bank Term Funding Program, or BTFP. You can see it keeps shooting up as deposit growth continues to roll over and head down. And if it gets worse, these banks are going to have to be forced to borrow more money from the Fed with literally no answer of how they're going to pay it back. Of course, we come back to this whole idea, the Fed's going to be back at 0% at some point. Now, I know many people don't believe that, but keep in mind, what else are the banks going to do here? They can't afford the interest on this loans they're borrowing from the Fed. They're losing deposits. They're upside down on their loan book. They're upside down on their asset book. They're upside down on everything. The only eventual solution is the Fed will have to go back to zero. That will drive deposits back into the banking system because people have nothing else or nowhere else to go, and that will offer some sort of stability. The problem is, before the Fed even gets there, things for the banks are going to get a whole lot worse. And then we're going to tie this into what's going on in the consumer space, because the two go hand in hand. And here you can see the revolving credit data. As we noted recently, it has contracted, which is fairly rare. Now, I want you to see that when you have big moves higher in, of course, revolving credit, and it slows down, you'll notice these little gray bars show up, and these are recessions. So you'll notice that you see revolving credit increase, which is fairly normal. As inflation rises, consumers can't afford it. They start using more of the revolving credit until they max out the credit, or the banks tighten lending standards, or a combination of both. And then next thing you know, you start getting into a contraction and a recession. Now, along the way here, we noted that coming out of the global financial crisis, the economy was rather weak, and you see intermittent contractions here. But notably now, we're having the same effect as we did going into the dot-com bubble and the global financial crisis, a surge in revolving credit that's now rewinding. And this is the issue that's now a matter of only weeks away. We're seeing commercial industrial loan growth is now down to 0.8%, which is not very good on a year-over-year basis, because when it contracts, now I want you to understand, when this thing starts to go negative, this means more money is being destroyed, because money is created in our system when commercial banks lend. So if on net they are not lending more than is being paid down, you get a contraction here, and that means it accelerates the destruction of money, likely drives deposits down, money supply down, and you can just see this huge vacuum pulling the whole economy down, because everything we do, if you've ever wondered, why did the Fed bail out the banks during the global financial crisis? Was it because they liked them? Is it because they regulate them? No, it's because without them, our system doesn't work. Now, I don't necessarily agree with what they did. That's beside the point. What I want you to see here is that loan growth is about to go negative, and for the banks who are already desperate for deposits, which guess where deposits are created from? You got it, new loans. You see, this is a big problem. And then when you look at interest rates on top of it, there's a reason why you see when loan growth goes down, interest rates fall, because it makes a lot of sense. And we'll come back to this chart in a moment. If people aren't borrowing enough to create lending growth, do rates go higher or lower? Though they naturally need to go down. The problem is everybody is short the bond market right now because they believe that rates need to go higher. Of course, the Fed thinks so too. The problem is that's going to also act as a massive break on creating new loans. And what I want you to see here is eventually rates are going to come down. Either the economy is going to drive into a massive recession, some sort of financial crisis, credit crisis, you name it, something's going to happen, because notably you can see when lending growth decelerates, yields come down. Why? Again, to spur people to go out and borrow. And you see it happen over and over again. The problem now is the banks are literally hemorrhaging. They're not healing. You saw it with the Bank Term Funding Program data. It's getting worse. Deposits are declining, and yet what's happening now is interest rates are being driven higher by market participants, which is going to further decelerate this and then drive commercial industrial lending into a contraction. And of course, we know when that happens, it's game over, recession, almost a certainty. And the deeper it goes, as we saw during the global financial crisis, the worse, of course, the crisis is going to be, because rates have to go down so low to get people to borrow. You start to make the case of why we could see rates across the board at zero. And this is why, of course, the banks are in trouble, because corporate America is now panicking. Now we're going to drive over to the consumer side of this as student loan chatter hits record on earnings calls, and something else should be hitting a record. Well, that'd be your trading account. Now, since we're talking about hacking our CTA-Timer Pro report, as some of our subscribers like to do, we've been talking now about how the banks are in big trouble. Well, this is the ETF symbol XLF. This is the big banks. And if you are following this chart and you were interested in and you were watching our report right here on this day, right here, the candlestick went up, but our machine said, our program said, look, if you look at the machine positioning, run a historical overlay, this is a point where you might want to start taking a short position. If you did, you'd be up 3% right now, and you'll see the stocks are breaking the 200-day moving average. This is that tan line. That is a bearish picture. Here you can see that signal on, of course, August 7th, the machine positioning now moving into a selling position. position. Again, if you like that, there was your indicator, and it's not too late. You can still be a subscriber. It's only $30 a month, and twice a week. We just put it out today. A note for all subscribers of things that they can put on their hot list that look like big opportunities. Check it out. Comes with a 14-day money-back guarantee. As corporate America is now panicking this earnings season as a prospect of more than 40 million Americans carrying student loan debt will have to start making payments in October. So now we're only about a little over a month away after a 3-year-long payment forbearance that has artificially boosted disposable income by tens of billions of dollars. So you think about this now from an economic standpoint. What do we just see in the banking industry? People are tapped out on their credit. They've maxed it out. They're starting to pay it down. We're seeing commercial industrial lending about to contract. And what do businesses need? What do the banks need? Right now, people to go borrow and spend. And what we're about to see is a massive break hit the economy as people face a whole nother payment. And using the document search function on Bloomberg, the phrase student loan and all second quarter earnings called soared to a record high of 151 mentions, suggesting that corporate America believes and is afraid that without the student loan forbearance, spending is going to dry up in a big way. And I think they're right. During the earnings call, companies in the financials, consumer discretionary, and consumer staple sector had the most mentions. Consequently, these sectors are poised to face the greatest exposure when consumer spending decreases. Of course, if you like to hack our report, you can keep a track of those ETFs and use our report to see how the machines are going to handle them. But look at what the CEOs and executives are saying is grim. From Target, the upcoming resumption of student loan repayments will put additional pressure on the already strained budgets of tens of millions of households. We remain cautious in our planning, not something optimistic for a second half rebound. How about Levi's? It's not going to help us. The consumer's already under pressure, and this is just going to ratchet up that even further. And Macy's, who we're going to look at again, the expiration of student loan forgiveness beginning in October, higher interest rates level, and lower new job creation are all pressures on the consumer. And what's interesting, this is pretty much the exact opposite what we're hearing from the Fed chair, Jerome Powell. You remember on Friday, he was there at Jackson Hole. We were there trying to get in and talk to him, get some answers, and they talk about how the labor market's strong and how people are still out spending. And we're getting the pulse right now that that is the opposite of what's happening. We see it in the banking sector, we're hearing it from executives, and now check this report out. Spend profile of the COVID suspended student loan cohort. Well, look at this. Student loan payers who suspended payments during COVID will have to resume those payments in October. The cohort of shoppers made up more than 10% of spending at several national brands in 2022, which is why these executives are worried. Their spending also outperformed. So there's key. So if you're outperforming without the payments, guess what's going to happen when they're back? Underperformance, as non-borrowers at several brands suggested that their lack of payments may have buoyed their spending in recent years, which is probably very obvious. That leaves dozens of national brands that benefited meaningfully from the pause of student loans, and that they may be more exposed to that shopper base as payments resume. And some of those are looking at Frontier Airlines was the most sensitive to the COVID suspended cohort. How about within the home sector? Peloton, you can see they're going to be in big trouble. And how about this? Also, we see outspending at Sherwin-Williams, IKEA, Ashley, HomeGoods, Wayfair, and Lowe's. And apparel, well, they're in trouble too. Old Navy had the highest share, with Nordstrom following that and Burlington behind them. So what's the factor here is a lot of businesses, a lot of big corporate American businesses, and this is going to flow into mid-size and small-size companies, are going to see the spending power of all of these people that were making student loan payments are going to dry up at a time they cannot access more credit, because as we've noted over and over, the banks tightened lending standards, and they did that because the Fed inverted the yield curve. And now we're only weeks away, of course, from that key commercial industrial loan data going into contraction, chewing up even more money out of the system and driving this thing right into the ground. And yet credit card issues must confront consumers mounting debt, as the problem is, who's going to pay it back if nobody has any money? The pandemic era savings cushions are gone, this according to J.D. Power. The economy is shaky, and consumers are leaning more heavily than ever on their credit cards to cover day-to-day expenses. this make or break moment for card issuers. And of course, we know who they are. They're the small and mid-sized and even some of the large banks, while high levels of revolving debt and declining financial health typically have a negative effect on cardholder satisfaction and loyalty. Well, obviously, that would be the case. If I don't have the money to pay on my credit card, I'm probably not going to be too happy with it. But does that keep people from spending and charging? Not at all. Issuers do have an opportunity to help customers by encouraging use of payment plans. Of course, that is the plan now. Extend it for longer and taking other steps to build goodwill and trust. It's easy when there's credit to have, but when it's time to pay it back, nobody's interested. And here's what's shocking, because I know many of you who comment say, hey, you know what, I use credit cards, but I don't carry a balance. Here's what's going to shock you. A lot more people that you know are carrying balances than you think. More than half, 51% of U.S. credit card customers are maintaining revolving debt on their credit cards. Among those cardholders classified as financially unhealthy, the percentage drops to 69%. That is staggering. Among those with card debt in the financially unhealthy category, the self-reported interest rate climbs to a whopping 16.5%, still lower than some of the public averages. But further, only 11% of financially unhealthy cardholders strongly agree that their card helps them control their spending. Look, last time I checked, is giving people credit does not control their spending at all. For most people, it is a drug. They spend and spend more and max the things out until there is no more. And that's how the credit cycle ends. You get these big boom cycles or this massive expansions of credit. And then all of a sudden, when you try to slow it down and you curtail that credit, what happens? The money evaporates. People can't make the payments. You start to go to delinquency and eventually default. And as you can see, this is going to spread in a big way, because we're headed back over to Macy's now. Check this out, because they're going to see a lot of these trucks on the road not go to their store anymore as Macy's swing to a loss in Q2 as customer situation deteriorates. And look at this, credit card delinquencies took 84 million bite out of revenue, but that's not just it. This is about credit card balances, Macy's said. This is about student loans. To say the obvious, which we know is going to come into focus in the next month or two. How about auto loans and even mortgages? Again, this is from Macy's. So we just believe that the customer is coming under pressure because there are new realities that they have to continue to deal with as we get through the back half of this year and move into next year. So you hear all these claims, well, we're not going to have a recession this year, maybe a little bit of a recession in 24, and then we're going to come out of it. The question is, how are we not going to avoid a recession if consumers have to go back and start making their student loan payments, which is going to cut discretionary spending, which of course the CEOs and executives of many of these major retailers are worried about, which means banks are going to originate fewer loans, which means fewer deposits are going to be created at a time when loan growth is going negative and is going to chew up money. The math on this just doesn't work out. And yet truck rates are abysmal, but some lanes are still active. And check this report out. As two transportation brokers, and this is what we're doing at the truck stop, trying to get answers on who's got loads and who doesn't. The truck rates are extremely low without a lot of hope of overall improvement on the horizon. So here you see it even in the transportation industry, they see the slowdown coming. And it's not a matter of if, but when there will be an upcycle. Well, eventually there always is. And right now, truckers are taking rates 15 to 25% below their costs. They can't last forever, they say. And they're right, because they will go broke. That's the problem. Everybody's financed to the hilt, they're leveraged to the hilt, and the economy is slowing. This happens in history all the time. And now, as a Macy's CFO pointed out, the auto industry, they're in trouble too. As car prices might be unsustainable for buyers, as surging loan delinquency signal that many consumers can't afford their loans. Well, if you can't afford your credit card, probably can't afford your car either. And these numbers could explain a mystery, but leaving the auto industry. Seasonalized rates of severe delinquency for auto loans are at the highest since at least 2006. Again, that was going into the global financial crisis, but yet they're perplexed. The job market is strong, or maybe it's not as strong as it appears because inflation was too high for too long. And usually you get the default spikes when unemployment spikes. I'll show you that chart in a moment. It's the biggest correlation in consumer credit. To see them go up that much while unemployment is low is not typical. In fact, it's not at all, because it all now adds to the next narrative. If consumers start cutting their spending, guess what we need less of? That's right, employees. And next thing you know, you spiral into an unsustainable, unbreakable crisis, because it's just going to annihilate the entire economy. Here you can see the delinquency rate on all loans in blue. When it's over that black line, it's going positive, and you can see that 4-week moving average initial claims. No surprise, delinquency rates go up, people cut spending, and yes, it continues to go up as people lose their job. The more people that lose that, the bigger the problem. And here's the claim: the delinquency rates are headed up, and we're not seeing a lot of layoffs, because, my friends, that is coming soon, and it's going to be broad, it's going to be deep, and the banks are going to be at the epicenter. You just see. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.